which AI data center stock is the better investment right now? CoreWeave or Nebius Group. In this video, we are going to do a very deep, detailed comparison between both of these companies, and we will analyze their revenue growth business model, demand drivers, risks, profitability, and valuation so that we can clearly understand which company looks stronger for long-term investors in the rapidly expanding artificial intelligence infrastructure industry. And before we go into the details, it is very important to understand that we are currently in one of the biggest technology cycles in history, which is the artificial intelligence revolution. And this revolution is not just about software or apps, but it is mainly powered by massive computing infrastructure, which means data centers, GPUs, cloud systems, and high-performance computing networks. And this is exactly where companies like CoreWeave and Nebius Group come into play, because they are building and operating large-scale AI data centers that provide computing power to big tech companies and AI startups. And the reason this industry is growing so fast is because artificial intelligence models are becoming extremely large and complex, and every new generation of AI requires significantly more computing power than the previous one. And this is creating a massive demand shock in the market for GPUs and data center capacity. Now, when we start with CoreWeave, we can see that the company has experienced extremely strong growth over the last few years. And in 2025, CoreWeave reportedly generated around $5.1 billion in revenue, which represents a massive growth rate of around 168% year over year. And this level of growth is very rare in traditional industries, but in AI infrastructure, it is happening because demand is currently far ahead of supply, and companies are rushing to secure as much computing capacity as possible. And CoreWeave is one of the major beneficiaries of this trend because it focuses heavily on GPU-based cloud infrastructure, which is exactly what is required to run modern AI workloads. And the important thing to understand here is that this demand is not coming from just one company or one sector, but it is coming from multiple large technology companies, including Microsoft, Amazon, Google, Meta, and many others who are all competing in the AI space, and all of them require huge amounts of computing power to train and deploy AI models at scale. And because of this competition, they are willing to pay significant amounts to secure reliable data center capacity, which creates strong revenue visibility for companies like CoreWeave. Now, when we look at Nebius Group, the situation is slightly different, but still very interesting. Nebius is a smaller company compared to CoreWeave, but its growth rate in percentage terms has been extremely aggressive. And this happens because smaller companies can scale faster when they start gaining traction in a high-demand industry. And Nebius has been rapidly expanding its infrastructure and customer base, which has led to very high revenue growth rates compared to its previous size. And although the absolute revenue is much smaller than CoreWeave, the percentage growth is extremely impressive, and this makes Nebius a higher risk, but also potentially higher reward investment compared to CoreWeave, and both companies are actually operating in the same ecosystem, which is the AI infrastructure market. And this market is being driven by one major factor, which is the explosion of demand for computing power as AI models become more advanced and more widely used across industries. And now, the way this ecosystem works is also very important to understand, because instead of building all data centers internally, many big tech companies prefer a hybrid model, where they build some infrastructure themselves, but also rent large portions of computing capacity from external providers. And this is where companies like CoreWeave and Nebius provide critical value because they act as infrastructure providers for the entire AI economy. And this business model is becoming increasingly important because it allows hyperscalers to scale their AI operations much faster without waiting years to build physical data centers. And this is one of the main reasons why demand for AI infrastructure is growing at such a rapid pace now. However, despite all this strong growth, there are also serious risks involved. And one of the biggest risks in this industry is oversupply, because both CoreWeave and Nebius are investing billions of dollars into expanding their data center capacity and building new infrastructure. And this requires huge capital expenditure on GPUs, server hardware cooling systems, electricity, and long-term facility development. And the concern is that if too many companies enter this space, or if too much capacity is built too quickly, then supply could eventually exceed demand. And when that happens, pricing power in the industry can decline, which means companies may have to lower prices in order to keep their data centers fully utilized, and this would directly impact profitability margins and long-term returns. And this is why, even though the current demand situation looks extremely strong, investors still need to carefully monitor the balance between supply and demand in the AI infrastructure industry, because it can change over time as more competitors enter the market now. When we move to profitability, this becomes one of the most complex parts of analyzing these companies because unlike traditional businesses where expenses are mostly operational in nature, here a large portion of spending goes into capital expenditures, which means building long-term infrastructure assets, and these include expensive GPUs, advanced cooling systems, power infrastructure, and large-scale data center construction, and these costs are not immediately expensed in the income statement. Instead, they are recorded as long-term assets and then gradually depreciated over several years, which means that traditional profitability metrics like net income earnings per share and even operating margins do not fully reflect the real economic picture of these companies in the short term. And this is why many investors prefer to look at cash flow metrics, but even cash flow must be interpreted carefully, because these companies are still in aggressive expansion phase and they are continuously reinvesting most of their cash back into growth, which means they may not generate strong free cash flow in the early stages of expansion, but that does not necessarily mean the business model is weak. It simply means that the industry is still in its early infrastructure building phase. And now, moving to valuation. Both CoreWeave and Nebius can appear undervalued depending on the assumptions used in discounted cash flow models. But it is very important to understand that valuation in high-growth AI companies is extremely sensitive because small changes in assumptions, such as revenue growth rates, profit margins, or long-term demand, can drastically change the final valuation outcome. Which is why investors should not rely on a single valuation number, but instead focus more on long-term industry trends, execution capability, and demand sustainability. And finally, coming to the conclusion, both CoreWeave and Nebius Group are strong players in the AI infrastructure space, and both are positioned to benefit from one of the most powerful technological trends of this decade, which is artificial intelligence expansion. And both companies offer extremely high growth potential, but at the same time, they also carry high risk due to heavy capital requirements, uncertainty in future demand and potential pricing pressure in the industry. But if we compare both companies directly, and if I had to choose only one, then I would slightly prefer CoreWeave over Nebius Group, mainly because CoreWeave is more established, operates at a larger scale, and has relatively more stable execution compared to a smaller emerging company. But at the same time, this is not a simple decision because Nebius also has extremely strong long-term growth potential and could potentially outperform if it executes well. And at the end of the day, the AI infrastructure industry is still in its early stages, and demand for computing power is expected to grow significantly over the coming years, as artificial intelligence continues to expand into every major industry. So both companies remain strong candidates to benefit from this long-term structural trend, and that is the end of the analysis.